We have not entered a soft landing. This might be contrary to what you've heard or read in the news lately, so we're going to lay out why we think a soft landing has yet to be achieved and what it will take to get there. We'll also talk about some risks to our financial systems on the horizon that might get in the way of achieving a soft landing, and what it all means for gold and silver investors. If you're here, you probably already know what the difference is between a hard landing and a soft landing, but let's take a moment so we're all on the same page. A hard landing is a recession which is defined as 2 quarters of consecutive negative GDP. A soft landing definition has been harder to pin down, but we defined it earlier in the year, and we're sticking to that definition. If the Fed's current tightening cycle ends, inflation reaches 2% and GDP remains positive, then a soft landing has been achieved. We also said in prior videos that we would know more in May this year, and guess what? We know more now. Much of the soft landing narrative has been about the fact that we have not yet entered recession, but that's not what characterizes a soft landing. It's about the end of the tightening cycle, lowering rates, and achieving price stability amid slower but still positive GDP growth. We won't be able to say we're in it until the tightening cycle ends, and we can earmark that for the day rate cuts occur. The latest news surrounding the start of rate cuts is from the June FOMC meeting. Combining that meeting with recent job reports, first quarter GDP, and inflation readings, it does not look like mission accomplished. Inflation is sticky, between 2.5% and 3.5%, and GDP was revised downward to just 1.3% in the first quarter of 2024, and on top of that, unemployment has ticked up slightly to 4%. The Fed has decided to maintain a restrictive stance and is now projecting the most likely scenario of 1 rate cut, and analysts expect it no earlier than September. The Fed has also said they are concerned that restrictive policies are not having the effect it traditionally has had on inflation. There are a couple of reasons for that, but let's think about this scenario for a second. With unemployment rising and GDP shrinking, we're getting closer to a recession environment. The inflation readings are printing higher than expected, meaning rate cuts will not occur for some time. So we're getting closer to a hard landing as time wears on and the Fed maintains their restrictive stance. There's one main thing that's pushing inflation readings higher than what the Fed would like to see, and that is deficit spending by the US government. Let's put it this way. First quarter GDP was 1.3%. For the balance of 2023, deficit spending was 6.2% of GDP. In other words, the economy is artificially being juiced by government taking loans and spending the money. If we didn't have deficit spending, we would be in recession at this very moment. But while deficit spending is keeping us out of recession, it's also putting us further in debt, and it's the main thing pumping inflation up. We're getting to a period of time where the name Milton Friedman is less known. For our viewers who are unfamiliar, he's a world-renowned American economist who won the Nobel Prize for his work on this exact topic. According to him, government spending is really the only thing that can cause inflation. They're the only ones, after all, who can increase the monetary supply. And inflation is simply a product of having more money circulating the economy than what the production of services and goods is worth, which then drives up the prices of those goods and services. So on the one hand, we have a Federal Reserve intent on bringing inflation to 2%, while Congress and the President of the United States are spending money we don't have to prevent a recession and causing inflation in the meanwhile. We're not going to get into the long-term effects and problems this will cause, but we do want to cover the more immediate effect. Rates will be held higher for longer, with a restrictive monetary policy. And the longer this goes on, the more likely we will have a repeat of the bank failures we experienced in 2023. Reports recently came out of an analysis conducted by a private investment firm that found 282 of 4,000 U.S. banks are at risk due to the commercial real estate crisis, which is exacerbated by the elevated rates the Federal Reserve has set. Commercial real estate has been identified as a multi-year problem by the Fed, with Chair Powell saying they expect bank failures in the future. And shortly after this admission, a $6 billion bank Republic First from Pennsylvania, failed at the end of April. And we bring up commercial real estate and bank failures because if we learned anything from 2008, it's the bank system needs to be healthy or a financial crisis may occur that affects everyone. The longer rates stay elevated, the less likely it is a soft landing will be achieved. And the more likely we either enter a good old-fashioned recession or financial crisis via repeated bank failures. And while many analysts have said a repeat of 2008 is unlikely, the truth is that we are in a new kind of situation that doesn't have historical precedent. The unrealized losses for Q1 2024 on bank balance sheets is $517 billion. Let's compare to 2008. Unrealized losses by banks were less than $25 billion at the start of the year. The Congressional Research Service provides Congress with CSR reports to inform regulators and legislators about issues of importance such as whether unrealized losses pose a threat to the banking system. And according to a CSR report delivered to Congress in April of this year, unrealized losses are not a solvency concern if the banks hedge their risk, potentially by buying interest rate swaps, for example. The CSR report goes on to say 75% of banks do not use swaps and only 6% of industry assets are hedged. It appears there is concern at the highest levels the banking system is not as sound as public press conferences would suggest. Now, what happens if bank failures begin again and create panic? In 2023, Silicon Valley Bank collapsed and depositor flight ensued. The Fed and Congress stepped in and put a Band-Aid on the problem, which worked. Some of the temporary measures put in place last year have been lifted, but depositor flight is still the number one thing that can topple any bank. Banks are required to give money back to depositors when they request it. They cannot say no by law. But banks don't have all the money they've been given. It's just not how they work. We give them our money to hold, and the bank loans it out to generate interest. It's how they make money and stay in business. So the balance for them is always to have enough money on hand to handle normal business operations. And if too many people panic and try to take their money out, then banks will need to sell assets to give money. And that is when unrealized losses become realized and banks become insolvent. Now, gold had a big run when SVB collapsed. We saw it on the retail side as well as investors came to understand the banking system was on shaky ground and they could lose a significant portion of their wealth. With FDIC insurance providing limited relief for bank failures, investors moved a monumental amount of money into gold and silver. Gold prices surged almost $200 per ounce in a matter of weeks, going from about $18.20 per ounce to $20.20 per ounce, an 11% increase. Silver ran up almost 24% in that same period. Not only are silver and gold great inflationary assets, but they're also a store of wealth that exists outside the banking system. In an environment like what we had in 2023, it's easy to see why it was the preferred asset. And in coming months or years, it's possible we see history repeat. We covered a lot of ground, so here's a quick recap. We're not in a soft landing yet, and we won't be in one until the Fed's tightening cycle has ended. The economy and the financial system are showing cracks, with banks carrying a significant amount of unrealized losses that could quickly result in insolvency if depositor flight occurs. The Fed has publicly stated they expect banks to fail due to the commercial real estate sector, and they are intent on keeping restrictive policies in place until inflation has been reduced to 2%. In opposition to the Fed's goals, Congress and the President are spending more than we make, racking up a deficit that is preventing a recession in the near term, but also creating inflation that extends the Fed's tightening cycle. When crisis occurs, it's possible consumers will again invest heavily in precious metals like gold and silver in response, driving another rally in spot prices. Investors who have stored some wealth in precious metals should be insulated from potential shocks in the system. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.